I get asked all the time, is the market gonna crash? Also, other people tell me the market is gonna crash. So today, what I wanna do is I wanna study and analyze the market based on data, not based on fear and misinformation. So let's start by talking about what is the definition of a market correction versus a market crash. For this one, I'm gonna read so I make sure I get it exactly correct. A real estate market correction is a moderate and healthy adjustment in home prices after a period of rapid appreciation. So in a correction, prices decline moderately, commonly up to about 10% from the recent peaks. It tends to be gradual and spread out. It can take months, maybe even years, not days and weeks. They're often a natural part of the market cycle, and it rebalances the supply and demand and brings prices closer to the fundamentals like affordability, wages, and economic conditions. So during these periods, market activity may slow. There's longer days on market, fewer sales. However, underlying fundamentals, jobs, the economy, credit, they remain relatively stable. So this is a period that we have been in for the last year or two. The second thing that I wanted to define is the difference between a market correction and a market crash. So in a real estate market crash, it's a severe and often sudden collapse in home values. So what does that mean? There's larger price drops, often well beyond 20% or more. Also, these declines happen extremely rapidly and they can be widespread across regions. So a crash usually results from systematic problems such as financial stress, a recession, widespread mortgage defaults, a debt crisis, not just normal supply and demand shifts in the market. Crashes are typically accompanied by higher foreclosures, weakened credit conditions, and broader economic downturns. So simplistically, a crash is a breakdown, not just a correction. It can shake confidence and cause long, painful recoveries. Now that we have defined those terms, let's dive right into the data. Let's talk about Fannie Mae and some of their data that can be indicators of what's happening in the market. Fannie Mae was established by Congress in 1938. You cannot get a loan directly from Fannie Mae, but lenders sell loans on the open market to Fannie Mae, and then Fannie Mae repackages them into mortgage-backed securities and sells them to investors on the open market. Now, in order for Fannie Mae to buy those loans, they have to meet certain criteria, and one of those criteria is the loan limits that they will allow. So let's look at this chart. The flat decade from 2006 to 2016 tells a powerful story. During that period, there was not a lot of house appreciation, and the market was recovering after the crash. During that time, Fannie Mae did not increase their loan limits. But let's look at the chart in future periods. Fannie Mae loan limits are tied to data, not speculation or hype. There's a reason that every single year, those loan limits have increased. That means that the market has normalized and stabilized and that they expect home prices to appreciate in the future. If they didn't, they wouldn't be raising the loan limits. If there were signs of a crash, then we would expect Fannie Mae loan limits to either flatten out, pause, or maybe even decrease. We are not seeing any of that in their behavior. So that's a key indicator that we are not in a crash. We just have been in a mild correction over the past year or two, and now we are expected to stabilize. In the next year, there is anticipated 3 more drops in interest rates and also more buyers to come out because that's going to increase buying power and affordability. One of the people that I highly respect and follow is Habib. He's been known in the industry to be studying data and be correct on his predictions and forecasts of the market for many, many, many years. He actually just got a seat on the Fannie Mae board in the middle of 2025. And one of the things that he says is to focus on affordability and demographics, not doom and gloom, market talking heads and people that are talking about, crashes to come because they're trying to get sensationalized headlines or more clickbait. Personally, I think that a big reason for the fear that people have today for another market crash to come is because the crash of 2008 is in our recent memory and it's just ingrained into the culture. So if you look at the data, even from Fannie Mae, they stopped raising their loan limits back in 2006, which was before the crash. So they're confident right now. They're also a very conservative organization. They didn't start raising the limits again until 2016 when they were confident that the market was gonna continue to appreciate and we were past and in recovery. So I want you guys to really look at that. Fannie Mae, if they had any inclination that there was a crash coming or something like that, then they would stop raising the loan limits. Why does all this matter? Well, market corrections can actually be a great opportunity for buyers and investors to come in and buy properties as prices normalize. If you wait for the next 2 or 3 price drops and you have more buyers coming out, then you're gonna have more competition, which actually could drive prices up and also reduce inventory. So right now is a great time to get off the sidelines and put in some offers and look for properties that you might not have been able to afford, a few years ago as the prices are lower before they go back up. So be smart, focus on the data. Don't sit on the sidelines just because of fear. If you really analyze this, most of the experts all are in agreement that the market is going to continue to normalize and stabilize in 2026 and 2027. So if you like this video, like, subscribe, and keep tuned in for more good information.